In today's video, I want to talk about one of my more popular shorts called The Power of Compound Interest. This video has over 20 million views to date and over 4,000 comments, all basically asking how to take full advantage of what's going on here. Why Billy was able to retire so much earlier than Timmy. Well, the simple fact is that Billy understands how exponential growth works, how compound interest works, and he understands how to invest his money so that instead of making money and spending it like Timmy does, he's investing and growing his wealth over time. So we're gonna first start talking about investing in general, and then we're gonna talk about stocks, which is what Billy used to grow his net worth so quickly. So be sure to watch this video all the way to the end so that you can learn how to grow your net worth exponentially. Now, the easiest way to start investing and growing your net worth is by investing in stocks. So what are stocks? Stocks are shares of a company, and it allows you to own a piece of a business. So let's say someone created a chocolate company that's now worth $500,000 and decides that they want to raise some money so they can buy more equipment, or maybe rent out a bigger building so they can sell more chocolate bars to people. So what they do is divide their $500,000 company into a million different shares. So now the company is split into a million different pieces, and every piece or share is worth 50 cents. So let's say this owner now sells 100,000 shares to someone else. At 50 cents each, the 100,000 shares is worth $50,000, and now this other person owns 10% of their chocolate business. Any kind of voting, decision making, profit sharing that the chocolate company makes, this person now gets 10% of that. And that's basically what a stock is. It's fractional ownership of a company. Now, there are two main ways to earn with stocks. The first one is through dividends. Dividends are when the company makes profits and they want to distribute the profits back to the shareholders. So let's say that this chocolate company makes a $100,000 profit and decides to share that $100,000 profit with all of the owners. So with a million shares out there and a $100,000 profit, you take $100,000 and you divide it by a million. So everyone basically gets 10 cents per share that they own. So going back to our other example, if one person has 100,000 shares and you get 10 cents per share, this person now gets $10,000 in dividends from the profits that the company makes. Now, the second way that you can make money through stocks is through capital appreciation. Capital appreciation is where you sell a stock for more than what you bought it for. So again, going back to our old example, imagine the chocolate company share value increases from 50 cents a share to 75 cents a share. That increases the value of the company by 50%. So in this case, the 100,000 shares that the person bought for $50,000 in the past are now worth $75,000 because of capital appreciation. So this is usually what people are talking about when they invest in stocks. So they're talking about how they bought Tesla at $100 and now it's worth over $900. Or how they bought Apple stock way back in the day and now it's worth 1,000 times more than what it was worth before. That's capital appreciation. And basically the factor that affects the stocks is how much do people as an aggregate value this company. So do people think that Apple is worth more today than it was 10 years ago? Now, of course, the value of a stock can always go down, and we'll cover some of those examples later in the video. So that was a brief explanation of stocks and the two ways that you can make money from it: dividends and capital appreciation. So now let's talk about two types of investing that you can do with stocks. There's short-term and then there's long-term investing. So short-term by definition is anything under 1 year of holding. So that means that you buy and sell a stock within 365 days. An example of this is day trading, where you buy a stock and you sell it on the same day to make a small profit. So short-term investing is generally more risky. You do have the potential to make money faster, but that risk often requires a lot of work. And if you look at stock charts, you'll see that on a day-to-day basis, the chance of the stock market as a whole going up or down is like 50.1%. But over a 20-year span, the chance is almost 100%. So basically, the shorter time frame you hold onto stocks, the less chance you have of it going up for sure. Honestly, I'm not a big fan of short-term investing because I think it takes a lot of energy, there's higher risk for it, and you get taxed more. So in my opinion, it's not the best way for starters. Now, the other type of investing is long-term investing. So this type of investment is where you hold on to something for over a year. And to streamline this, I do something called dollar cost averaging. It's when I continuously buy stocks at a certain dollar amount so that whether the stock value goes up or down, I buy the same amount of money. But if the stock price just happens to be down that day, then I just end up buying more stocks. And when the stock price goes up, then I end up buying less stocks. Another thing that long-term investors do is they tend to diversify their investments. So instead of putting all of your money into one stock, they tend to diversify and buy mutual funds and lower risk assets because they know they're in this for the long haul. They may also be more interested in the dividend producing portfolio because they know that they're guaranteed returns every month. These companies are historically good at giving out dividends, and if you're investing in a long-term index fund, you can see that these index funds tend to grow at a steady 8 to 10% a year. So these index funds aren't gonna pop off and give you like a 3-time return in 1 year, but they're very stable. And the taxes on long-term investing are also much better. So I think this is a better option for starters because it's much easier to do. And then over time, this thing just grows and grows and grows. So basically that's how compound interest works. So what is compound interest exactly? Compound interest is where money just increases over and over again, but instead of just relying on the money that you put into it, eventually it grows based on what's already inside of it. I'll give you an example. There's a famous story of a person that was given the option to either have a magical penny that doubles in value every day for 30 days or $1 million. So you might be thinking, a penny doubling every day? That's not gonna end up being too much. And even on the 15th day, halfway through this journey, you're only gonna be at $327.68, super far off from $1 million. But if you go all the way through, then you're gonna end up with $10.7 million. You would end up with much more money by taking the penny that doubles for 30 days, taking the $1 million, which is not intuitive. So now that you understand the power of compound interest, here are some of my tips when it comes to investing. First one is to make it a habit to dollar cost average, because this way, you're not always hovering over your phone, checking the stock market, and worrying about the value going up and down. Just continuously invest through the ups and downs. And yeah, some years, the stock market may go down. But again, if you dollar cost average, that just means that during those years, you're able to buy more stocks. So if the market recovers, which it generally does after 1 or 2 years, then your value goes up significantly. You also don't want to be the person that sells all of your stocks when the market is down and then forget to buy back in, because when the prices recover, you'll miss out on all those gains on the way back up. Another thing is that when you buy stocks, I highly recommend diversifying and buying index funds instead of buying individual stocks. An index fund is just a pool of individual stocks across different sectors and different categories. So this way you don't have all of your eggs in one basket, and if the company goes bankrupt, you don't lose all your money. So an example of this is Blockbuster. Blockbuster was a huge company back in its heyday, and you would never think that they would go bankrupt. But here we are, 20 years later, and they're all gone. Another example of this is Peloton. So for those of you who don't know, Peloton is an exercise bike, and people were really into it back during the heydays of COVID. During those times, people were stuck at home, so they bought these Peloton machines to work out at home. And as you can see from the graph here, from January of 2020 to January of 2021, the stock increased from around $30 a share all the way up to $150 a share. This is insane. This is like a 5 times return. And you may have thought, damn, I should have bought it when it was here because now it's all the way over here. But the fact of the matter is no one knows where the stock is gonna be, because here we are 2 years later and the stock is now at $16. So if you bought the stock at its peak, you would have lost 90% of your investment. Now, I'm not saying that Peloton's a bad company because I didn't do any research on this, but I'm just showing you this as an example that if you put all of your eggs into one basket, then you would have lost a significant amount of net worth. So I recommend diversifying as much as you can and dollar cost average. So that way you're consistently buying into the stock market. As my friend says, invest early and invest often. So now if you want to get started with investing in stocks, I recommend using Webull. Webull is a great platform and it's really easy to get started because it's free to use, there's no cost when you trade stocks, and they allow you to buy fractional shares, which means that if you don't have enough money to buy one Apple share at $300 a pop, you can buy a fractional share for as low as $5. Now the great thing about Webull is that they also give you some free stocks for signing up if you use the link down below and deposit at least $100. The promotions may change, so be sure to take advantage of this right away. Now remember, you're not losing $100, you're using this $100 to invest. You can always sell the free shares they give you from the bonuses, which you get and cash out. It really doesn't matter. These are your shares and you can invest them however you want. Getting started is what matters the most. Now, if you got to this point in the video, some of you might be thinking that this is all great info and all, but I don't have the extra money because I don't get paid enough with my job, and investing is not for me. So if this resonates with you, then check out this video where I talk about how to be a millionaire even with a low salary. Thanks for watching, guys. I'll see you next time. Take care.